going through a divorce is emotionally challenging, but it also brings significant financial complications that many people aren't prepared for. When a marriage ends, you're not just separating your lives, you're dividing everything you've built together, from bank accounts and homes to retirement savings and debts. Understanding how assets and liabilities are split is crucial to protecting your financial future. In this video, we'll break down the key financial implications of divorce so you can navigate this difficult process with greater confidence and clarity. Before dividing anything, you need to understand what's actually subject to division. Property in a divorce falls into two main categories. First, there's marital property, which includes nearly everything acquired during the marriage, regardless of whose name appears on the title or account. This could be your home, cars, bank accounts, or even businesses started during the marriage. Second, there's separate property, which typically includes assets you owned before getting married, as well as gifts or inheritances you received individually during the marriage. Separate property usually stays with its original owner and isn't divided in the divorce. How your assets get divided depends largely on where you live, because states follow different rules. Most states use equitable distribution, which means assets are divided fairly but not necessarily equally. Courts consider factors like each spouse's income, contributions to the marriage, future earning potential, and individual needs. The other approach is community property, used in 9 states including California, Texas, and Arizona. In community property states, all marital assets and debts are split 50-50 down the middle, regardless of who earned more or contributed what. Understanding which system your state follows is essential for setting realistic expectations. Divorce requires dividing many types of assets, each with its own complications. Real estate and home equity are often the most valuable and emotionally charged assets to split. Retirement accounts and pensions accumulated during the marriage must also be divided, even though you may not access them for years. Bank accounts and investment portfolios, whether joint or individual, are typically considered marital property if funded during the marriage. Finally, vehicles and personal property like furniture, electronics, and jewelry all need to be accounted for and fairly distributed between both parties. Retirement accounts deserve special attention because they require specific legal procedures to divide properly. For 401k plans and pensions, you need a qualified domestic relations order. Known as a QDRO, this is a court order that allows retirement funds to be split between spouses without triggering early withdrawal penalties or immediate taxes. Without a QDRO, you could face significant financial penalties. Individual retirement accounts, or IRAs, are somewhat simpler. They can be transferred directly from one spouse to another as part of the divorce settlement, and when done correctly, this transfer happens without any tax consequences for either party. Just as assets must be divided, so must debts, and this can be equally complicated. Credit card debt is typically split, with joint accounts divided between both spouses, while individual cards usually remain the responsibility of the cardholder. Mortgages are tied directly to property, so they're often refinanced in one spouse's name if they're keeping the house or paid off when the property is sold. Auto loans usually stay with whoever is keeping the vehicle, since the debt is secured by that asset. Student loans generally remain with the person who borrowed them, even if they were taken out during the marriage, though this can vary by state and circumstance. Divorce can significantly impact your credit score in ways many people don't anticipate. Here's the critical thing to understand. You remain legally responsible for any joint debts even after your divorce is finalized. If your ex-spouse is supposed to pay a joint credit card according to your divorce agreement but misses payments, your credit score will be damaged too because creditors don't care about divorce decrees. To protect yourself, close or separate joint accounts as soon as possible during the divorce process. Remove your ex-spouse as an authorized user on your accounts and vice versa. Most importantly, monitor your credit report regularly during and after the divorce to catch any problems early before they cause lasting damage. Divorce creates several important tax implications that can affect your finances for years. When selling your home as part of the divorce, you may qualify for capital gains, tax exclusion if the sale occurs within the settlement period, potentially saving you thousands of dollars. Alimony rules have changed significantly. For divorces finalized after 2018, alimony payments are no longer tax-deductible for the payer, and the recipient doesn't report them as taxable income. Your filing status will also change once the divorce is finalized. You'll file as either single or, if you have dependent children living with you, as head of household. This change affects your tax rates, standard deduction amounts, and eligibility for various credits, so planning ahead is essential. Divorce is too complex and consequential to navigate alone. You need a team of professionals to protect your interests. A divorce attorney understands your legal rights, negotiates on your behalf, and represents you in court proceedings if necessary. A financial planner helps you understand the long-term implications of settlement offers and creates a strategy for rebuilding your financial life after divorce. A tax advisor evaluates the tax consequences of different settlement options and helps you minimize your tax burden. Finally, a mediator can facilitate negotiations between you and your spouse, helping you reach fair agreements without the expense and stress of going to court. Each professional brings specialized expertise that can save you money and stress in the long run. Let's recap the most important points to remember. First, understand your state's property division laws before agreeing to any settlement, because the rules vary dramatically between equitable distribution and community property states. Second, protect your credit score by separating joint accounts early in the process, because you remain responsible for joint debts regardless of what your divorce decree says. Third, carefully consider the tax implications of every asset transfer decision, because the immediate value and long-term value can be very different once taxes are factored in. Finally, seek professional guidance from divorce attorneys, financial advisors, and tax professionals, because their expertise will help you avoid costly mistakes and secure the best possible financial outcome. Divorce is difficult, but with the right knowledge and support, you can protect your financial future.
If you like this video, hit that like button and don't forget to subscribe. Visit CodeLucky.com for more such useful content.